Hi, it's Rich here, founder of Under the Radar Report. It's great to be back. Such interesting times on the market. Who knows what lies tomorrow? The key is to keep it simple. So with that, I'm going to give you 3 portfolio management tips and 3 small caps that we like. The best portfolio management tip I can think of is buy what you understand. So generally speaking, that means buy what you own. And when I'm talking about what you own, I'm talking about the quality end of your portfolio. So what is quality? Well, quality for a lot of companies is their customer base. You cannot go past a good customer base, whether it's volume of customers, type of customers, but basically this is the essential asset that means business can be confident about the future. So that's the first thing to look at, customer base. Also look at balance sheet, also look at cash flow. They're the 3 things to look at for quality. So keep that in mind. The second point is don't bet the ranch. Buy in small chunks. So when you do see prices fall, don't chase, don't be too aggressive, just keep your buying, keep it to a minimum. Small incremental purchases. I mean, we're not trying to overdo any one bet in the markets. We're just trying to be consistent and we're trying to keep it clear head. The third point I'd like to make is spread your risk. The basic learning of the investment industry, of finance in the past 20, 30 years has been the importance of diversification. Diversify by company, diversify by industry, diversify across the business types and across size. You cannot achieve a diversified portfolio without small caps. Small caps are less correlated to the index because they're not in the index. Having said that, you do need to have a core portfolio. You need to be very confident that the stocks that are the bedrock of your portfolio are going to be there tomorrow, the next day. So that means looking at dividend paying stocks, looking at stocks with strong balance sheets, looking at those elements that I talked about before that determines quality. So make sure that you keep those things in mind and just have a good time. I know sometimes the market can be very scary, but it's important not to get carried away. Just to think it's paper, it'll go up tomorrow. These companies aren't going away. They're going to be here tomorrow. They're going to be here the next day. They're going to be here next year, in 10 years' time. Let's get on to the stocks. Let's talk about a stock that I own that I think is one of the highest quality stocks in my portfolio. Hansen Technology. Hansen Technology is a great company because they're a utilities software provider to really big utilities. So they have a tremendous customer base and they have long contracts. So that's 2 big factors in their favor. Plus they're broadening out their business model. And mind you, that that transformation has been a case of 2 steps forward, 1 step back, but this is a founder-led company, so they have a long-term vision. And we believe that they can achieve that vision. Basically, their on-premise solution is their core business, and now they've bought Power Cloud. They've got API or plug-in, a cloud type business. That means that they can compete, across a much broader range of companies. So competing with Octopus and with Gentrack. So this boosts their business model, but it hasn't been easy. So check out Hansen Technologies. The second stock I want to mention is another company that is high quality, Macquarie Technologies, MAQ. This company, I've been a fan of for a long time because I like their founders, the Tudor Hopes. Basically, these guys own 60%. So this company is really founder-led and it has backed themselves in data centers. We all know the importance of data centers. They are crucial to how the cloud works and to the implementation of AI. So they're at the center of where IT sits. But they're going through a big transformation. I mean, they are trebling the size of their company. They are trebling the size of their company with a 45 megawatt data center that they're building. That is a big deal for a company that's as successful as Macquarie Technologies. So it means that their debt's going to go up, the risk goes up, but it transforms the company into a growth company. And there has been like a capital raising. That's the first capital raising since I can remember. So the first capital raising for 25 years. Their debt's going to go up, so financial risk increases. But what you're getting is a gold-plated asset with gold-plated customers, government customers, and big IT customers like Amazon, like Microsoft, like Google. So this is a tremendous opportunity in technology, change or die. These guys are changing and we're backing them. The third company is much higher risk. It's firmly in the growth category rather than being core. So this one is one of those companies that, okay, you really don't want to be putting as much as the former two in, but I think it's got great prospects because Intelligent Monitoring Group is in the securities area that is expanding very quickly in Australia, and through their purchase or their acquisition of ADT, they've got a dominant position in a fractured market. So they've made like 11 or 12 acquisitions in the past few years, but the management team is very good at implementation. So they've got a great position in corporate, with clients like BHP, with NextDC, and they can provide an Australia-wide solution. Plus, in the bigger market that's retail, they've got ADT, which is a well-known brand, and they can take advantage of the 5G network, which lowers the cost of expansion. So this is a great company in the making. So it's still earlier in its life cycle. There's still more risk, but it's looking very good value, trading on 4 or 5 times cash flow. And we think there's a big chance that this roll up will give them more economies of scale, so they'll increase their profit margins. These are 3 great companies for different reasons. As I say, diversification is what it's all about. And I look forward to talking to you soon.